Greetings and salutations, everybody. I'm your host today, Rick Siddiqui, and I'm going to be talking with Nick Macron from Oxford Mortgage on the inside scoop on the Fed's bold move regarding their rate cut. There seems to be a lot of misconceptions going on, both with people in the industry and also in the media, that they're basically conveying wrong information. So we're here to clarify all that and to give you more of an education on what this is all about and what it really means to you. So take it away, Nick.
Yeah, Rick, thank you for having me. I think this is an important topic because, my gosh, it's been a long time since the Feds have cut rates, right? So I think it's important that, like you said, for people in and outside the industry, let's wrap our mind around what this actually means so that we can get a grasp on it, convey it correctly, set realistic expectations for people kind of moving forward here. Yeah.
Awesome. Now, can you explain the current state of the mortgage rates and how they've been impacted by the Fed?
Yeah. So, right now, it obviously, Rick, it depends. Scenarios are different, right? Down payment, credit score. But let's just pretend good down payment, excellent credit score. Okay. I mean, you're going to be right about 6%, maybe just below, maybe just above, kind of depending on the day. But yeah, I mean, I locked one the other day at 5 3/4 on a conventional loan. So your rates have improved a lot. I think what people don't realize is that since, I don't know, September, October of last year, rates have improved by over 1.5 points. I mean, rates were in the high sevens. I mean, there were times where it was touching 8% there, right? And that's just in the last 12 months. So it's pretty exciting that rates have gotten back down to what at least feels like a more manageable level for people.
I see. Now, Nick, I do know that some people have been asking about, isn't now the better time for, instead of a fixed rate mortgage, why not go for an adjustable rate mortgage? So could you tell us the differences and how is this impacted by the rate cut?
Yeah. So yeah, absolutely. So everybody's scenario is going to be different in what they're comfortable with, right? So let me explain what an ARM is first for people who don't know. So ARM stands for adjustable rate mortgage. Typically, say a 5 or 7 year ARM means your loan is fixed for 5 years or 7 years, whatever ARM you choose. Then after that, it can adjust with prime, the LIBOR, whatever. If the Fed raises rates up or down, your rate can adjust at that point. Okay. For the most part, lenders' pricing of ARM loans is still not that attractive. There's not as much of a margin as there used to be between the 30-year or 15-year and the ARMs. So still not super attractive, quite frankly. I do think as the Fed funds rate starts to go down, you might see some more of a spread there like there used to be. Listen, you're talking to a guy who's just very conservative. It doesn't mean that an ARM loan isn't good for some people who know for a fact, I'm only here for a 3-year stint for work or a 5-year stint for whatever it may be. But I like the fixed products better myself. But there are opportunities for ARM loans. They're just not pricing out real well right now.
Right. Again, it all depends on the scenario of the person.
That's right.
Actual mileage may differ, and
that's right. And I think there's a lot of people, Rick, where, in 2007, 8, 9, right? Kind of in that time frame, ARMs were a big part of the problem during the meltdown, right? Values had dropped, ARMs were adjusting, people couldn't refinance. So there's a lot of buyers, even ones who an ARM might be a good fit for, from a financial standpoint, aren't comfortable with ARMs because they saw what happened back then. I mean, they are available, and they move kind of with prime the same way, right? I mean, if rates improve on a 30-year fix, theoretically they're going to improve on the ARMs as well. So, but that margin's not very good right now.
How do you think the Fed's rate decision will affect the housing market in the short term?
Well, I think what I've seen just in the last week is it did create some excitement, right? I think the one thing to know is that the Fed funds rate is the rate at which banks borrow money from each other overnight. So it really has nothing directly to do with mortgage rates. So there was a little bit of a misconception that rates dropped a 0.5 point. That's not really how that works. Okay. And mortgage rates already had this built in leading up to Wednesday. So strangely enough, mortgage rates actually worsened because they had already had it baked in, right? So the rate had already assumed it was going to do what it did. But on that same day, a retail sales report came out and it was better than expected. And so those kind of things are not good for rates. Like when if jobs reports are really good or retail sales are really good, GDP is really good, that's bad for mortgage rates. So
Mhm.
just coincidentally that day they improved with the Fed, but they got worse with mortgage rates. So
Okay.
correlate, but they're not. It's not a direct.
It sounds to me like it's inversely proportional. Like, as you said, retail and GDP and a couple of other factors, when they're good. Okay, I could see where this comes from now,
Yeah.
or why it is. I mean, it's kind of like the law of supply and demand. When
Well,
supply
yeah,
is up,
it's exactly
it
right.
correlates similar to that, right?
Yeah, because what happens is, the Fed has, and Jerome Powell and the Fed, they have two mandates, right? One is inflation, manage
Hmm.
inflation. The other is the labor market. The Fed is more likely to cut the Fed funds rate when those things are not going well. Well, on the labor market, when inflation is doing better, the Fed will cut rates. When the labor market is struggling, they will also cut rates because they're trying to kind of balance this, you know, the two. So when you have like a strong GDP or a huge jobs market or something like that, that is not great for the mortgage-backed security market, the bond market. It's good for long-term yields, which is what drives rates up.
Okay,
Okay.
gotcha. Now, Nick, can you walk us through the process of how rate changes impact mortgage applications and approvals?
Well, yeah. So obviously we're getting more applications. A lot of them right now are refinances. To be honest with you, Rick, there's a lot of people that have bought over the last couple of years, even that were already at a place where they're saving a point and a half. Okay, so
Mhm.
it drives up the applications there. We're also getting several more purchase applications because people are just excited again, right? I mean, I think what it did, even though mortgage rates didn't do a lot on Wednesday itself, what it did was it was kind of some positive marketing on the news, right? Like, hey, Fed lowered rates, and so you start to get people to call that didn't realize rates were at 6%. They thought they were at 7%. I think we talked about last time that there was somebody at the team meeting for the real estate office that you're in who afterwards said, "Yeah, I've got this buyer who I just can't get off the fence. They're just not comfortable buying at 7%." Like, well, that's good because rates aren't 7%, right? So I think that this created an opportunity where a lot of buyers who were maybe dipped their toe in the market before and were like, "Oh, geez, 7.5, I'm not doing that." Found out some good news that over the last year rates had come down, right? So that being said, what it can do to the market is, it can create some excitement, which I don't think will do anything crazy to the market itself. But in the longer run, if the more supply and demand, right, the more buyers that are in the market, unfortunately, the higher those prices can go, competitive offers
Oh
and
yeah.
things like that,
Oh,
right?
yeah,
So,
because the inventory of homes is basically fixed to some extent, and when
right.
there's more demand, then of course there's going to be a lot more activity.
But I think if you look at those people that are like, I'm not leaving my 3.5% for 6.5%.
I
Well,
mean,
that's true, but you know what? That conversation very well may um, move to the next level if rates are 5%. Like,
hmm
okay, I mean, I hate to leave 3.5, but five's pretty good, right? I
yeah,
can handle five, right?
right.
So I think if it continues kind of at this trajectory, I think you might see more listings, but you'll definitely see more buyers too. It's all good stuff. I mean,
Yeah.
it's not quite as sexy as it sounds sometimes, right? Like,
Mhm.
when people who don't know what they don't know hear rates have been cut by a half, they think, oh my God, mortgage rates dropped a half today. I mean, I've been dealing with that with the clients that I already have that are in underwriting. Like, oh, I heard rates dropped a half, right? I want 5.5 instead of 6. Like, no, that was already built in. That's not how this works. And I have to explain it again. Um, but it's all good things, right? I mean, for guys like you and I that have been in the business for a long time, it's just feels super positive to be on the opposite side of the rate conversation with the Fed.
Mhm.
Because my goodness, when it started in 2022, the rate increases, I mean, everybody knows it was just nonstop. Till it got to a really high level that was uncomfortable for people on HELOCs, credit cards, new car loans, things like that, right? And so it's just nice where we need to be, but we're going down now, which is just feels good, right?
Right,
So
exactly. I mean, I've always said perspective is a matter of perspective. I mean,
yeah,
when you have something that was so good, then that becomes kind of your baseline. And
Right.
then you see everything raising and you're like, whoa, it's really high now. And as you said, like when people that were in the 3%, when they see things at 5%, then that becomes a bit more palatable.
I think what's hard, I think, for people in the business, right, and well, not just for people in the business, is that the COVID era, that's not realistic, I should say,
Right.
right? So when people are, when you're having to deal with it with sellers, right? Thinking, hey, my neighbor sold in 2021 and they got X. Well, that's different, right? And it sold in a day. Now it's different. Same
Mhm.
thing with rates. Like, oh, my last house was 2.5. I understand that, but that 2 year period um, was an anomaly, right? That
Right.
was caused by a global pandemic, right?
Right.
So I think rates in the fives, what that means, 5.5, five, whatever. Um, that's healthy. I mean, it's healthy for banks. It's healthy for buyers. And if you look at the 20 and 30-year historical maps of rates, I mean, you're closer to 6.75, right? So, it's like I've said forever. I'm not naive to the point that we have a affordability problem right now, especially in Colorado, but we don't have a rate problem. See, that's the hard part, right? Like rates can help us with the affordability, but rates don't care what prices are. It's not like they're like, oh shoot, man, the average price is 800 now. We need to take rates down to 3. It's just not how it works. So,
Right.
but this is exciting because it's happening. It's happened a lot quicker than people that aren't in the business realize. I mean, a point
Right.
and a half in a year,
Right.
right? I mean, if that happens again, you're in the fours. I mean, you think a point and a half in a year, and that was prior to any Fed rate cuts. So what can happen if the Fed cuts by 200 basis points over the next, year?
Mm.
Including the 50 we just got. Say it goes down to 300 or 325. My goodness, that's a major improvement to rates. So,
Right. Right.
yep,
And yeah, I am familiar with that. Back when rates were at 7, everybody was saying the sweet spot, they're not going to do anything until the rates get down in the 5s.
right.
And again, it's all comparative.
Yeah, and what's hard, Rick, and I know I'm getting off topic a little bit, so we'll get back to the questions. But the hard part is for buyers that get fixated on a rate. Okay, and again, it's not. I'm not poo-pooing their thought process because I get it. We all have to calculate payment. But when I mean, I've been doing this a long time, so have you. I've got a ton of clients through the years that when rates were 5, they were waiting for 4. When they were 6, they were waiting for 5. Okay. So now when they got to 7.5, all they wanted was 6. Well, they could have had it at 4. And in that time frame, not only did the rate change, the house price went from 5 to 7. Right. So as cruddy as that is, that's a cautionary tale of find the right place.
Right.
And you can afford it. There's never a bad time to invest in real estate because
Right.
it's just an investment. You're just investing in a property.
Yeah.
Right. You got to be able to afford it, of course.
Right.
But it's tough because prices don't go down usually.
Right. This all ties into that whole thing of marry the house, date the rate.
Right.
Exactly
Yeah.
that. Okay.
Again, and listen, I mean that I've talked with a lot of people, the last couple of years with that line, and that we don't want to sound flippant because you do have to be comfortable and it has to fit in your family budget, right? So, and you never want to buy banking on refinancing because you never know. But all the data tells us this is what's going to happen. So get the house before it goes up another 100,000 and get a lower rate when it does go down, right? So,
Mhm.
yeah.
All right. Okay, cool. So how can home buyers take advantage of low rates and what should they consider?
Well, one thing that we're recommending right now is, if you think you might want to be in the market, do an online application, whether it be with us or with somebody else. Get an application in so that you're ready to act when the right place comes up. Okay. Even if it's on a refinance, a lot of conversations we're having with our past clients right now is, hey, listen, I know what's your jump off point? My jump off point's 5.5. Cool. Well, let's get your app done, and I will watch rates every day. And when we get to 5.5, do you want me to lock it? Yes, great. Because you need to be ready. Because
Right.
unlike 2011, 12, 13, most years, honestly, since I've been doing this the last 20 something, rates back then would just be, here's the rate. There were years where rates hardly changed, right? I was barely checking rate sheets and pricing loans out with rates because they were always the same. right now rates are very volatile, right? I mean, it's like this. So you want to be ready to take advantage of it when it comes. The other thing too is there's all sorts of neat programs out there. I mean, just because we're getting into lower rates doesn't mean things like the 2-1 buy down programs, right? Where the seller buys your rate down for you for by 2% for the first year and 1% for the second year. There's a lot of neat ways to take advantage of getting a really low rate while we theoretically wait for lower rates.
Right, exactly.
Yeah.
So,
Mhm.
are there any specific loan programs or options that benefit from the rate drops?
Yeah, well, I think the buy down programs are still attractive, right? Even though rates have come down a little bit, it's great. You can get down to a considerably lower rate, and it's cheaper. It's a cheaper concession for the seller, so it's more likely to work because rates are lower. And it's sellers right now Rick, we're in Colorado, right? So sellers right now, more than having a long time, are willing to play ball on stuff like that because things are sitting just a little bit longer.
Right.
So yeah, I mean, I would say the buy down programs, and then I think right now the fixed loans because as the rates have gotten lower, the arms, like I said, that delta between the two is just not,
Mhm.
Isn't that sexy, if you will,
Mhm.
right? So yeah.
So it does sound to me, Nick, that right now, basically, to some extent, the buyers are in the driver's seat. I mean, I understand that the sellers are basically 6 to 12 months behind on the market, and they still have that expectation that my house is the best on the block and it's going to sell in a couple of days, like barely before the sign gets in the yard. I should have offers. That's their thought process. That's what I hear from others, and in the industry, and it just seems like, as you pointed out, it's like there are some options. There are options now that can favor both the seller as well as the buyer, and it's all up to
Yeah,
the buyer to
exactly. I
basically
mean,
pursue.
listen, you're having a tough conversation with sellers, right? I mean, it's
Right.
because
Expectation.
they weren't in the market before, so they don't know kind of what's changed. They just know what they've heard, and um, but I will tell you from our standpoint on what we're seeing come in on contracts, there are a lot more um, uh, buy down programs, a lot more seller concessions, um, more, trying to think of what else, more price reductions, things like that than I've seen in a long time. Now,
Hmm.
that could be in a vacuum, and that's just the kind of stuff I'm getting, but I don't think so. I think we're seeing sellers that after they've been on the market for 30 or 60 days are like, okay, well, maybe we need to
Yeah.
revisit this and market this way and market that way. So, yeah, but I mean, I think that for the first time in a while, the buyers are at least on level playing field with sellers, right? So,
Mhm. Good. Now, how do rate changes impact refinancing? And is now a good time for homeowners to refinance?
yeah, we're doing a lot of them. We're looking at every deal individually, right? For some of the people that we did, like I said, back in October of last year that bought, that were 7.5, 7.75 in rate, that were locking. I mean, I locked one guy that was at 7.75. I locked him at 5.625.
Mm.
Right. So in that case, absolutely, it's time. For some, it's not quite there yet, but we want to have that evaluation process with them that says, okay, right now we're 3/4 more. Again, Rick, where's your jump off point? Well, I want to be at this payment. Okay, well, that will put you at 5.75. So I'm gonna constantly, like a psycho, watch your deal for 5.75, and I will let you know the second it's there, and we'll get it locked. You good with that? That's kind of the conversation we're having. The other thing that we're seeing a lot of right now, Rick, is cash out refinances, right?
Mhm.
Because people who maybe have 4% currently, where taking 6% or 6.25 doesn't sound like a great deal, but they may have $1,000 car payment, $600 in student loans, a
Right.
$900 HELOC. I mean, name it, right? Just $40,000 in credit card debt. We're seeing a lot of that, right? Where even though we're taking up their rate by 2%, we're taking their outgoing down by $1,000 a month
Mhm.
because we're taking up their loan amount, paying off all their debt, and their mortgage payment went up by X, but we paid off Y, and their outgoing has improved substantially. So we're doing a lot of cash out refinances right now.
Okay.
I mean, because you've heard, I mean, we all watch the news and we've heard that credit card levels are at, all-time highs, $1 trillion in credit card debt.
Hmm.
People are hurting, especially with how credit card interest rates shot up over the last couple of years. People are paying, six, seven, $800, $900 minimum payments on stuff, and so there's some relief potentially on these cash outs.
How do you stay up to date with the market trends and rate changes, and how do you communicate them to your clients now?
We get a market update from a trusted source that we follow every morning. Kind of, what reports are due out, whether it be, personal consumption expenditures, other inflation readings, jobs reports, all those things, so that we have a grasp on what the week is going to look like, what the day is going to look like. And then we also get some guidance from them. Hey, we're kind of at a level on the mortgage-backed securities where I don't know if we're going to get over, we may drop down, so carefully float, or we're alerting you to lock rates, those kind of things. And then, for our active clients, we're having those conversations daily. Hey, here's what it looks like today. Do you want me to lock? For people that are just kind of been spitballing it a little bit, we'll send out kind of email blasts so that people know and what rates are doing, so that they don't miss something because they didn't know. The realtor side, I mean, we send out rate sheets weekly, kind of generic rate sheets, market updates, things like that.
So how do you work with realtors like me to ensure a smooth transaction for our clients?
Well, I think, Rick, what you know about me is that, I want you and I to be kind of involved together as a united front the whole time, right? So, I don't divulge buyer personal information to you, but you are going to be aware of, hey, appraisal has been ordered, appraisal is in, rate is locked, figures are at title, clear to close, all those kind of things, so that you can, convey those as well to the buyer. So that it's like, oh, exciting. I know you talked to Nick, but I heard your appraisal's in, it came in great, those kind of things, right? So I think for us, Rick, it's communication. We just want to make sure that we are a good extension of you and other realtors. So we keep everybody in tune and, tied into the process the whole time.
All righty, cool.
Yeah.
Now, can you share some insight on future rate locks, trends, or predictions?
What I think is going to happen, so the Fed meets again, I think it's November 7th. I think they're going to cut by another quarter. There is discussion that it could be another half. I think there is some belief with a lot of economists out there that think that the Fed is actually behind on the rate cuts and that they should have started sooner, right? Because now you've made borrowing more restrictive with the increased Fed rates over the last couple of years. But the labor market is now struggling. So you need to start lowering rates so that the labor market picks up, people start hiring, doing all those kind of things, borrowing money for this or that. I mean, there's a lot of different things that they're trying to do. So I think it's possible that we could see 0.5% in November. My guess is that by the end of the year, they're going to cut 100 total. So we've done 50 already, 25 November, 25 December. And then, if things continue on the path they're on, I would guess about this time next year, we'd be down another 100 in 2025 for a total of 200 basis points. That'd be good.
Okay, so translating that.
Guessing 5%, to be at 5%, I think that's a healthy market for banks, for borrowers. I think that also puts it to a point where if you can get seller concessions for rate buy downs, things like that, all of a sudden you're buying down into the 4s, right? I mean, I think that's about where we'll be. Which, shoot, that would be a very good place to be for consumers here.
I guess that is all we have for today.
Well, that's awesome. And listen, I mean, here's the thing I will tell people, and we mentioned this at the very beginning. Rates are different for every person because of their scenario, whether down payment, credit score, loan type. Are you doing FHA? You doing VA? You doing conventional? Right. So, you want to talk to a mortgage professional, whether it be me or somebody else, to really figure out where you're at. Get pre-approved. Kind of a funny story. I know we've talked about this before, but I had a buyer that just closed a few months ago who I called. They didn't really want to do anything because they're like, Nick, I need my rate to be at 6.5%. This was a few months ago. I said, okay, well, what does 6.5 mean to you? Why 6.5? Because I need my payment to be under $3,500. I said, okay, well, that house that you're interested in with rates where they were, which was at the time over 6.5, her payment was like 32 something. You were already under 35.
Yeah.
Right. So I think it's important for people to take that extra step, talk to somebody, let them get you real information so that you can make educated decisions and not, just make things up on your own. Because I'll tell you what, I tell people all the time, does anyone ever know what the rate on their car is after they close? No.
Just the payment.
They know the payment, right? So, and I'm not saying that you don't want to know your rate, and that's not important. What I'm saying is, let's figure out what the payment is and make sure that that's comfortable for you. Because then the rate is the rate, right?
Right.
After you close and you put that folder in your filing cabinet, someone's going to say, what's your mortgage rate? And like, oh, I don't remember. I'll have to look. Right? I mean, I do this for a living. I have no idea what my interest rate is. I'd have to look. I mean, I refinanced a couple years ago, right? But yeah, I mean, just talk to somebody, get a grasp on what it looks like. But I do think it's going to be an interesting time over the next year. I think it's important if you think you want to buy, if you can afford it comfortably, you might want to consider buying before rates hit their bottom. Because
then everybody's going to be competing.
Prices will go up. And if you already have the house, that's the way. The only way you get the best of both worlds is buy the house when it's cheaper, refinance when the rates are lower. Because if you wait for the low rate, you get one, you don't get the price, right? And the sad part is people are like, well, I want that 3/4 difference in rate. I totally get that. So do I. But if you pay $70,000 more for the house, your payment is exactly the same. I mean, that number's not exact, but you know what I'm saying.
Right.
If you overpay for the house, who cares what the rate is? You just overpaid for the house, your payment's exactly the same as it would have been. Right. So it's just important to get out ahead of it, get the real information. And then, that way you're ready to pull the trigger when you're ready to pull the trigger. Right.
Right. Once you see that balance of where the rate where the rate is comfortable and the price is where it's at, rather than everybody's competing while the rate is like super low, then you don't win.
That's exactly right.
Yep. All right. Awesome.
All right.
Well, Nick, thank you so much for your time. I really appreciate you and the sage advice that you gave us. Is it sage? Okay, it is sage.
Very good. Yeah, I liked it.
It's not
You're
ordinary.
welcome. I appreciate you having me on all the time, man. I look forward to doing it.
All righty. Okay.
Okay, Rick. I'll talk to you, man.
On a side note, this is the 3rd episode we have done. We might as well call it the Nick and Rick Show.
Yeah, exactly. It actually has a nice ring to it.